Dividend growth investors, bonjour, Mike here, founder of Dividend Stocks Rock and passionate investor. Welcome to this last video of a 7-day series. So if you're a little bit late, go back, look at our playlist. We have launched a 7 series. So every day since January 1st, I'm telling you how retirees or soon to be retiree will be able to manage their portfolio, improve it, make sure it's safe, generate some income, sleep well at night. So basically, I'm helping you to invest with more conviction so you can enjoy your retirement. Yesterday, we discussed what was inside the Canadian retirement portfolio at Dividend Stocks Rock. And today, I'm giving you what's under the hood for the US retirement portfolio. One of the reasons why I decided to create 2 different portfolio models is quite simple. It's some of you guys are Canadians and have maybe corporate accounts or non-registered accounts, and it's not that interesting to invest on the US sides in with a tax optimization in mind. So what I decided to do is to offer you the 2 solutions. So you have like one retirement portfolio that is 100% Canadian, so you can use it to in non-registered account or in corporate accounts. And then if you have RSPs, if you have a RIF, if you have a Lira locked-in account, and all of those retirement portfolio, or if you're just a American investor, well, there you go. You have the full 100% US portfolio. Or maybe you're a snowbird and going to Florida for a few months every year, so then you need some US dividend income. But you'll see for this one, I cheated a bit to make sure that I generated a high yield, but at the same time, a safe one that will come with dividend increases. So results are as of December 21st, same thing as the Canadian portfolio. We're gonna take a look at the stats. So we do have 22 holdings in this one. The average portfolio yield slightly lower than the Canadian market, 4.7, still very good, but the 5 years of dividend growth rate is at 8.7%. So we're talking about a very solid portfolio that can go through all kind of challenges. So now let's take a look at the sector allocation. Sector allocation, I think it's key for any investors, but it's even more important for retirees. So for the US sector allocation, I decided to follow the same rules that any other portfolio models, meaning that I don't want to be exposed more than 20% in a specific sectors. Obviously, there are sectors that are a little bit more retiree friendly, meaning that they show stable business model, they show a high yield, and they just show like a lot of sleep well at night companies. Among those, you'll always find utilities, real estate, some banking, but in this case, we don't have that much in financials because on the US sides, it's not my favorite sector. Instead, I decided to focus on the American market strength, such as looking at healthcare. We don't have any great healthcare companies in Canada, but we have a bunch of them in the US. Consumer staples like Coca-Cola, again, companies that are present across the world that has multiple ways to grow their earnings and at the same time manage iconic brands. I have some consumer discretionary and communication services, 8-9%, not too much. A little bit of energy. Again, I'm not too kind of energy and basic materials. I know they saved the day in 21 and in 22, but to be honest, if you look at the next 10, 15, 20 years, do you really think that this is the sector where you want to have your money there? I'd rather go on the safe side and focus on solid dividend growers that will still generate 4 or 5% yield. So let's now take a look at what it looks like. So you can see, as usual, you have like the pro ratings and the dividend safety score. Again, our goal here when you look at those 2 charts is to make sure that you do not have orange and red. So as long as you don't have any orange and red, you can expect in terms of dividend safety score that there will be a little bit more yellow than other portfolio models because our ratings is according to the ability of this company to increase its dividend. So the darker green stellar dividend will be companies showing a double-digit dividend growth rate or close to that for several years. And then you have good dividend that will be between mid-single too high single digit. Obviously, if you're looking for stocks paying at least 4 or 5% yield, it will be hard to find that magic unicorn paying you 5.4% yield on top of offering you a 7% dividend growth rate year after year. Those are not necessarily very easy to find. You have Canadian banks that are getting close to that right now, but it's really because there was a bad market in 22. So now let's take a look under the hood. You'll see that I've cheated, and I'm telling you right up front, and it's a good way for all Canadian investors to have a combination of the US market and the Canadian market. So as you can see, we have Brookfield Infrastructure Partner, we have Canadian Natural Resources, Restaurant Brands International, Royal Bank, Bell, TD, Brookfield Renewable. All of those companies could be trading on the Canadian market or the US market. So it's a luck for you if you're American, but if you're Canadian, I suggest that you go for the Canadian ticker and make sure that you receive the money in Canadian dollar. It's a great way to combine both, and at the same time you can benefit from companies like Gilead Science, Coca-Cola, AbbVie. Those companies, you don't, even Unilever, you don't have those kind of companies in Canada. So this is a great way to improve your diversification, make your portfolio a little bit more stable throughout time and a little bit more solid. As you can see, you have smaller position that we added throughout time, such as 3M, VF Corporation, Atlantica Yield, and Medical Property Trust. Those are more to generate a lot of income and maybe a good play for potential growth, but they come with a lot more risk. So you have to be careful with those. This is why also they have not a huge weight in the portfolio. So you have to think when you build this kind of retirement portfolio to just focus on very strong companies at first. Those should be your largest holdings, and then at the end you can spice it up. So this is what we decided with 3M, with Medical Property Trust. So they bring a good yield right now, but they come with a higher level of risk. We are willing to take on that because the rest of the portfolio is very solid. So if you decide on the other way around, saying, oh, I'm going to focus on those small companies, like the small weight of those companies, and I'm going to make them the core of my portfolio, then you may run into a lot of problems. So you always have to focus on diversification first and make sure that your largest holdings are incredibly solid. So when you look at Brookfield, Realty Income, Gilead Science, Canadian Natural Resources, more than 20 years of dividend increases. Coca-Cola, AbbVie, they are dividend kings. So we have a great mix here. And this is how I would build a portfolio if I was American. I would still pick a few stocks from the Canadian side, especially to improve the rate. Now, you can download this complete report and download also our Canadian retirement report. If you subscribe to our free newsletter, the link is in the description below. You'll have access to both portfolios on top of an invitation for our next webinar next week on January 12th. If you're watching this a little bit late because you were on vacation, don't worry. If you click on the registration button, you will get access to the free replay right away. In this webinar, I talk about the major teams of 2023, sorry, kind of got lost here. So the major themes of 2023, some interesting stock picking ideas for defensive plays, income plays, growth plays, and some hidden gems, the companies that we don't talk too much about. So this will all be found inside this webinar. 2 hours. I always have a session of question and answers as well. So you'll have a bunch of free newsletters that you will be able to download, a lot of resources to help you start the year on the right foot and make sure that you invest with conviction for 23. So I hope that you have enjoyed this quick series. I hope that it has helped you to build a better portfolio and invest with more confidence. And starting next week, we will go back to our regular schedule. So 1 video per week on Thursday. So until then, don't forget to stay invested.